Now we're going to talk to you about the whole concept and definition around cash generating unit. Now, what's the meaning of cash generating unit? When you look at the financial statement of a company, and when we talked about the value in use, the definition of cash generating units is actually relevant from the perspective of recoverable amount. And recoverable amount has been defined as higher of fair value less cost to sell or value in use, right? So fair value less cost to sell or value in use of what? And that is where the concept of cash generating unit in a way comes in. So cash generating unit is, as the name suggests, is an asset which is capable of generating cash inflows, right? Which is capable of generating cash inflows independent of other elements of the business. So in a way, it's like a discrete set of activities within a business which can generate cash flows, right? For which the discrete financial information is available in a way, or can be made available from that perspective. So if it is a single asset, for example, which can generate cash flows independent of other assets of the business, that single asset itself is a cash generating unit. Now, if that single asset is not capable of generating cash flows independent of other assets, then you look at the smallest identifiable group of assets which are required to come together to generate cash flows, right? Ordinarily, the way we see this is, let me give you a very simple example. Let's say a business, right? A business which has multiple divisions, division A, B, C, D. Ordinarily, you see that division A is actually a cash generating unit, a B is another, C is. So these divisions are operating independent of other divisions. However, it may so happen that division A and B are very, very closely related to each other. They have to work together in a way to generate cash flows. Then division A and B together will form a part of, together will be a cash generating unit. If A, B, and C have to come together to generate cash flows, which are discrete cash flows independent of other business activity of that enterprise, then ABC actually becomes part of a cash generating unit, so on and so forth. So the definition of cash generating unit in a way suggests that a cash generating unit is defined as the smallest identifiable group of assets that generate cash flows that are largely independent of the cash flows from other assets or group of assets. This has to be independent set of cash flows. The identification of cash generating unit should be based on judgment. It's an area of judgment, right? For you to determine discrete cash flows, to say that what is the smallest group of assets which are coming together in a way to generate a set of cash flows, influenced by how they are monitored internally and the independence of the cash flow from those of other assets or cash generating unit. So from a recognition of a cash generating unit, you've got to determine the recoverable amount for the individual asset if possible. If that's not, then you've got to determine the CGU for the smallest identifiable group of assets that generate cash inflows that are largely independent from other group of assets. So cash generating unit, which are to determine the cash flows, if possible, if they are capable of generating cash flows which are independent of other assets, then you do it at the individual asset level itself. But ordinarily, that's not the case. That's not the case is what we see in practice. Then what does it mean? You've got to look at a group of assets which, when come together, are capable of generating set of cash flows. Then that is where you got to determine the recoverable amount, and recoverable amount is the higher of fair value less cost to sell or value in use, right? So at that level where you can actually determine the discrete cash flows or independent cash flows as with reference to other assets of that business enterprise, apply the CGU concept if the asset recoverable amount cannot be estimated, if the asset does not generate cash inflow independent from other assets, and its value in use cannot be estimated to be close to its fair value less cost to sell. And that is where we apply the whole concept of cash generating unit. Let's try and understand this with the help of an example. So we have a publisher here who owns 150 magazines, title of which 70 were purchased and 80 were self-created. So a magazine publishing house, 70 are purchased and 80 are self-created. And ordinarily, as I said, that in the intangible asset, you purchase an intangible asset, you capitalize them. The price paid for a purchased magazine title is recognized as an intangible asset. The cost of creating magazine titles and maintaining the existing titles are recognized as an expense when incurred. Cash inflows from direct sales and advertising are identifiable for each magazine title. Titles are managed by customer segments, right? Titles are managed by customer segments, all right? The level of the advertising income for a magazine title depends on the range of titles in the customer segment to which the magazine title relates. In a way, management has a policy to abandon the old titles before the end of their economic life and replace them immediately with new title for the same customer segment. What is the cash generating unit for an individual magazine title? Now, here the key question in so much of information given is your capability to generate cash flows, right? And when you think about the information here, is that the cash inflows from direct sale and advertising are actually identifiable for each of these magazine titles. Now, if you can determine, so recognition of CGU is defined as the smallest identifiable group of assets that generate cash flows that are largely independent of the cash flows from other asset or group of asset. In this given case, the likely that the recoverable amount, because they discontinued again at each of the title, they don't discontinue a customer segment in its entirety, right? And the replace one title is now bad or not able to generate enough advertising streams, replace it with another title within that customer segment from that perspective. So likely that the recoverable amount of an individual magazine title can be assessed even though the level of advertising income for a title is influenced to a certain extent by the other title in the customer segment. Cash inflows from direct sales and advertising are identifiable, and hence that is something which becomes a cash generating unit. It is likely that the individual magazine title generate cash flows that are largely independent of each other, and each magazine title is a separate cash generating unit. Right? Important for you to understand this. We got to look at the smallest identifiable, and that is why in this situation you got to an answer that each magazine title is actually a cash generating unit in itself. And if you were to test it for impairment, then at that level you have to possibly test it for impairment. Compare the carrying value of that magazine title with their ability to generate future cash flows, or compare with the fair value less cost to sell, higher of the two, then you're going to assess it for impairment. Let's look at another example, right? Here we're trying to say that how they're interdependencies, and if they're interdependencies, then you don't look at in isolation, but actually you look at things being together. So here XYZ Limited produces a single product and has multiple plants, 1, 2 and 3. Each plant is located in different country. Plant 1 produces a component that is assembled in either plant or 3. The combined capacity of plant 2 and 3 is not fully utilized for a variety of reasons. Now, XYZ Limited produced products are sold worldwide from either from plant 2 or plant 3. They are capable of themselves to produce in its entirety by taking the input from plant 1. The plant 2 production can be sold in plant 3 country if the products can be delivered faster from plant 2, from plant 3. Utilization level of plant 2 and plant 3 depend on the allocation of sales between the two sites, right? If there is no active market for plant 1 product, what are the cash generating unit for plant 1, plant 2 and plant 3? Now look at the way the whole description is. There is a lot of interdependencies. They don't have independent markets. The output can be sold plant 2 country, output can be sold in plant 3 country, plant 3 country output can be sold in plant 2, depending upon the logistics, depending upon the production schedule, depending upon the demand, etc., etc. And the component price produced from plant 1 is used as an input in plant 2 and plant 3. So essentially, we are looking at the recognition of CGU, which is cash generating unit, is defined as the smallest identifiable group of asset that generate cash flows that are largely independent of the cash flow from other assets or group of asset. In the given case, likely that the recoverable amount of each plant cannot be assessed of its on a standalone basis, and hence you need to look at all of three possibly together. There is no active market for plant 1. Therefore, plant 1 cash flow depend on sale of the final product by plant 2 and plant 3. Although there is an active market for the product as generated by plant 2 and plant 3, but the way the management runs the whole business, they determine the production scheduling, they determine the sales allocation, all of that depending upon various dynamic factors, and hence they look at them as together as a single unit of account, and that is why all of them are here considered together. As a consequence, it is likely that plant 1, 2, and 3 together are the smallest identifiable group of assets that generate cash flows that are largely independent of other parts of this business. So it's important to remember this is an area of judgment. So whatever the judgment you want to apply in this given fact pattern, you got to document it, you got to rationalize it and apply it appropriately, and then conclude it to say why you believe that this is to be considered as one group of asset. One CGU is all three plants coming together, and not plant 1 is a separate CGU, plant 2 is a separate CGU, plant 3 is a separate CGU. So here you've considered all of them together as one single CGU, because there is a lot of dependencies of cash flows in between plant 1, 2, and 3. Now, we're going to now move ahead and going to compute the impairment loss measurement and allocation, and that's an important area, and this is an area where we do see again some of the questions in the examination, and you got to be very, very careful again of the details what is there in the question paper for you to in a way get it right. So if the carrying amount, so when there is an impairment, if the carrying amount of an asset exceeds its recoverable amount, the carrying amount should be written down in a way to the recoverable amount, and the impairment loss is immediately expensed in the profit and loss account. However, if you were previously following a revaluation, now to the extent of the revaluation surplus, you first absorb it in the revaluation surplus account, and then any excess loss, if there is, that then gets charged to the profit and loss account. So we've talked about that at length when we discussed the concepts around Ind AS 16 or Ind AS 38, right, for intangible assets or for tangible assets. From that perspective, when the asset is carried at a revalued amount, the impairment is accounted for as a decrease of the revaluation surplus over and above, then that goes to profit and loss account. And asset should not be written down below zero. Below zero, there's nothing out there, right? Below zero, there's no more loss, right? You already impaired it. Below zero, there can be a question of potential liability, that do I need to pay actually, for me to continue to operate this asset, right? And is there a present obligation? So you got to look at again the definition of liability, and then determine, do I need to record an obligation in my financial statement, from that perspective. Otherwise, you don't go below zero. The new carrying amount forms the basis for future depreciation, as we saw in one of the previous example, over the asset remaining life, and deferred tax has to be calculated. Again, deferred tax has to be done with reference to book basis balance sheet and tax basis balance sheet. You determine the difference between the two. So now in the books itself, if you have impaired the asset, the carrying value has changed. So you compare the carrying value with your tax value to determine the deferred tax, though we will discuss that in more detail when we talk about Ind AS 12 on determination or assessment of deferred taxes. So now we're going to look at this case study. Okay, so on the reporting date, Gamma Limited is carrying an asset in its financial statements. Using the details provided, calculate the impairment loss and the current year depreciation. Okay, my purchase cost is 5,60,000. My useful life is 10 years. Residual value is 0. Carrying value at the start of the year is 2,73,000. My remaining useful life is 3 years. recoverable amount at the start of the year is 1,20,000. Clearly a problem here, right? INR 1,40,000. This is a unique information here. INR 1,40,000 revaluation increase recognized in previous years. That means here I'm doing revaluation method of accounting, right? Now remember the principles of revaluation. If there is a gain which you record and there is subsequently there is a loss, and the loss is first used to offset the gain, okay? Then the balance, if any, goes to profit and loss account. That's the principle, is what you need to always remember. Awesome. So I'm going to look at my carrying value, which is 2,70,000, compare that with my recoverable amount, higher value in use, or fair value less cost to sell. Do I have the information? I have the information on recoverable amount, assuming that's the higher of the two is already here. So I'm going to figure out what is my total impairment loss, which is 273 minus 120. Right? And then I'm going to look at how much is my revaluation surplus. That will go to revaluation. Balance is going to record it as my impairment loss. Okay, let's look at the solution here. Step 1, recognition principle is the amount by which the carrying amount of an asset or a cash generating unit exceeds its recoverable amount. Since the asset is measured under the revaluation model, impairment loss is first recognized in other comprehensive income to the extent that the impairment loss does not exceed the amount held in the revaluation surplus, which is 1,40,000. The balance, if any, is recognized as an expense in the statement of profit and loss account. Okay, now I'm going to look at the treatment of impairment loss here. So total impairment loss is 1,53,000. Fairly simple here. So I don't see a problem. 1,53,000 is my total impairment loss. Now from the above loss, INR 1,40,000, okay, 1,40,000 will be charged to OCI, which is the balance in the revaluation. 13,000 will be charged to statement of profit and loss account. Now I've got the revised book value, which is 1,20,000. So, and then the remaining useful life is 3 years. As you know, residual value is 0. So my depreciation will be 40,000. 40,000. All right. That's how I'm going to look at this solution. Fairly simple. Okay, awesome. So let's look at the impairment loss accounting for CGU. Now, first, the impairment loss should be allocated to any goodwill. So how do you now do the allocation? So in this example, let's say, assuming, let's say this is the cash generating unit and I've had this loss, which I need to now allocate. So out of this total loss, of 15,30,000 in our example, how do I allocate this? So if there is any goodwill which is sitting in that cash generating unit, if there is any goodwill here, that first you allocate the loss to the goodwill. If there's any goodwill, you allocate the loss to the goodwill, right? Once you allocated the loss to the goodwill, the remaining amount of impairment loss gets allocated to other assets on a pro rata basis. But again, you don't go below 0. That the second is you don't go below the realizable fair value of that particular asset, which is forming part of that asset group. Commonly we see, let's say you have receivable, or if you have cash in that asset group, you don't allocate to receivable below the estimated recoverable amount. The reason is why, if you allocate it, right, what will happen? That next period you will have a reversal of the gain, reversal of the loss. So you got to apply your mind, right? It should be applied on a pro rata basis against the other asset in the unit, but not as to write down any below the highest of 0. Value in use if determinable, fair value less cost to sell if measurable, right? And then you allocate on a pro rata basis. Loss for a cash generating unit ever be included as a liability only if another standard required. That means it has to meet the definition of a liability. Then only you will record that as a liability. Now let's try and understand. There are many times we dealt with a situation that whether we have corporate assets, right? That means you have when you're trying to do an impairment assessment, there are impairment triggers, external triggers, there are internal triggers, and hence now you have to test it for impairment. Now you're saying that, look, these are the different cash generating units, but there are certain assets which are called corporate assets, right? That's a corporate headquarter building. Very commonly we see. Now this corporate headquarter building is actually helping all the different components of a different cash generating unit. So now you got to figure out an appropriate mechanism to allocate the, if the one question is that, is the corporate headquarter in itself is a cash generating unit? What does that mean? That the corporate headquarter can itself generate cash flows, right? Now more likely than not, the answer is no, corporate headquarter is not able to generate cash flow of its own. If corporate headquarter is not able to generate cash flow of its own, then you need to allocate the carrying amount of the corporate headquarter to appropriately determine the amount of impairment loss for that particular cash generating unit. So if there are multiple cash generating unit and their corporate headquarter, you got to allocate it on a reasonable basis, and more often than not, the reasonable basis is actually the carrying value of those cash generating units. At times you got to also weight it with reference to the estimated useful life of those cash generating unit, and provide an appropriate weightage to that, and that's how you do the allocation, and then you determine the impairment loss is there, if any, and then you allocate also the impairment loss to the corporate headquarter and also to the other, all the assets which are forming part of that cash generating unit, from that perspective. So the corporate assets include group or divisional assets such as the building of a headquarter, EDP equipment or data processing equipment or a research center. Such assets do not generate cash inflows, right? They do not generate cash flows of their own, and hence they are working together with other cash generating units. Corporate assets are required to be allocated to cash generating unit on a reasonable and consistent basis. Recoverable amount of an individual corporate asset cannot be determined unless management had decided to dispose of the asset, and that is why they're being determined in totality with the cash generating unit. And if there is an impairment, the recoverable amount is determined for the CGU to which the corporate asset belongs and is compared with the carrying amount of this CGU or group of asset. So let's now look at this case study, okay? If they're unallocated assets. So we talked about, right? You're going to do impairment testing at first at the CGU, and then you go to do this at the unallocated, then you do it at the overall level as well to make sure everything has been considered here. Okay. Now, Wonder Limited is in the automobile parts manufacturing business, all right? It has identified two CGU in its business to which no goodwill has been allocated in the past. Below mentioned are the carrying value of the CGU. So Wonder Limited is in the automobile parts manufacturing business. It has identified two CGU in its business to which no goodwill has been allocated in the past. Okay. CGU X is 200 million and CGU Y is 300 million. Okay. In addition to the above, Wonder Limited has certain corporate assets. Okay. So I have certain corporate assets in the form of building used as a corporate office, which is not included in the value of the CGU. So the carrying value of the CGU, 200 million, 300 million. I have another corporate building, which is not included in this carrying value. Assume that the corporate asset can be allocated to the CGU in proportion to their carrying value, which is 2:3. Okay. The corporate office building is carried in the books of Wonder Limited at INR 100 million. Oh, it's a big building. Now, Wonder Limited has determined the recoverable amount for the CGU based on value in use as below. Okay. Which is 180 million and 380 million. Assume that the fair value less cost to sell is lower than the value in use as provided above. Okay. Should Wonder Limited provide for impairment loss for CGU X and Y? Okay. Right. So I'm going to look at this solution. Okay. So here basically essentially first we need to allocate the unallocated asset to this, and then we have the information to determine how much is my impairment loss. So corporate assets, they do not generate independent cash flows and hence not tested for impairment separately. However, if corporate assets relate to certain CGUs and the cost can be allocated on a reasonable basis, then such CGU should be tested for impairment after including such allocated assets in its carrying value. Therefore, corporate office should be allocated, okay? Should be allocated to X and Y on a reasonable and consistent basis. So I have 200 and 300, which is 500. Then in the ratio of 2:3, I'm going to allocate the carrying value of CGU, including allocated corporate assets, is now 240 and 360. Okay. And my recoverable amount, which has the information given, which is 180 and 380, is 560. So my impairment loss is 60. So I will now allocate this impairment loss, okay, against office building. I'm going to allocate in the same proportion. If there is a goodwill, first you allocate to the goodwill. If there's no goodwill, then you allocate to the principle of allocation. You allocate in a similar proportion, provided it doesn't go below its fair value less cost to sell, right? Now we don't have the information on fair value less cost to sell, so I'm going to simply allocate here based on the relative value. So office building is 40, right? 40. And then 240 is the total, and then 60 is the amount. So 40 by 240 into 60, so that gets allocated. Okay, and then against other assets is 200 by 240 into 60 is 50 million, right? So total 60 million gets allocated. Okay, total 60 million gets allocated. 10 million to the building and 50 to the CGU. All right. Let's look at this examination question, which was covered in November 2018 for 10 marks, right? Here XYZ Limited has 3 cash generating unit, X, Y, and Z. The carrying amount of which as of 31st of March 2018 are as follows. For XYZ, the cash generating unit, the carrying amount is 800, 1000, and 1200. The remaining useful life here, this is the important thing here, is 20 years, here's 10 years, it's 20 years. So there is a difference in remaining useful life of these independent cash generating unit of XYZ. XYZ also has corporate assets having a useful life of 20 years. Now the corporate units are AU and BU. The carrying amount is 800 and 400. Look at the information which has been provided. The carrying amount of AU can be allocated on a reasonable basis to the individual cash generating units. So the question suggests that you should allocate the carrying amount of AU to these cash generating unit. The carrying amount of BU cannot be allocated on a reasonable basis to the individual. That means then you now need to look at in totality, right? And we will try and understand how all of this has to be dealt with. Now the recoverable amount, we have more information here. Recoverable amount as on 31st March 2018 for the CGU X, Y, and Z is provided 1000, 1200, 1400, and for the overall business is XYZ all put together for that company is 3900. Required is calculate the impairment loss, if any, for XYZ Limited. Ignore the decimals. Ignore the decimals, right? Now, what do I need to do? I need to follow step 1 here, right? What is my step 1? Step 1 is I need to first determine the carrying amount, right, of these CGU. What are the CGU? X, Y, Z. Then I have this assets, corporate units, right, which I need to allocate to X, Y, Z in an appropriate manner. What I can allocate, what I can't allocate, right? Then I got to compare the carrying amount with the recoverable amount, right? Now the recoverable amount is determined as 1000, 1200, 1400, and then for one building which corporate unit which cannot be allocated, I also need to do it on an overall basis. So I now, once I've determined the recoverable amount, I need to then compare the carrying value with the recoverable value to determine the amount of impairment loss. That's what I need to do here. Let's try and see how we need to approach this from a solution perspective. So how do I determine the carrying value? I need to allocate the corporate asset, right? First thing is for me to determine the carrying value. Otherwise, the carrying value of XYZ was already given. So I now need to allocate the corporate asset. So I have two types of corporate asset. Carrying amount AU is allocated. A weighted allocation is used because the estimated remaining useful life is 20 year, 10 year and 20 years, right? Of these three different cash generating unit. So how am I going to do it? If you look at the carrying amount, XYZ was 800, 1000 and 1200. This is the information given. The useful life is 2, 10, 20 years, 10 years and 20 years. So I'm going to apply the weight, which is 2, 1 and 2. These are the weights which are in a way being applied. You multiply this with reference to the carrying amount 1600, 1000 and then 2400, so 5000 after applying the weight. And now you know the carrying value of AU. Carrying value of AU was how much? Carrying value of AU is 800, right? That information is also given. Now this 800 gets allocated in 32%, 20% and 48%. That's the important thing you need to understand here. You're trying to do it based on rationale, right? Based on a systematic basis, right? And the systematic basis is that whatever is the carrying value, that would have been a very simple, that if then you would have done 8 is to 10 is to 12, right? Now we are not doing into 8 is to 10 is to 12, right? Why I am not doing this? Why I am not doing this is because there is a difference in useful life. If the useful life would have been 20, 20, 20, I would have simply done in the ratio of 8 is to 10 is to 12. But because the useful life is not 20, 20, 20, I'm applying a weight. I'm applying a weight here, doing to 2 is to 1 is to 2, and then get to a 32, 20 and 48, which is 100, and then allocate this 800, which is 256, 160 and 384. So my carrying amount after allocation is 1056, 1160 and 1584. That is a total of 3800. Now the other corporate unit, the information suggests it cannot be allocated on a reasonable basis, and hence I have to do that on a totality basis. But first, what I can allocate, I need to do the impairment testing at that level, and that means that I'm going to now compare the carrying value with the recoverable amount, right, for XYZ. Now the carrying value here, what information I have, for each of these cash generating unit, the carrying amount after allocation is 1056, 1160, 1584, right, which is 3000 plus 800. And then the recoverable amount, the information which is provided for AXYZ, 1000, 1200 and 1400. Here I have an impairment loss of 56. Here I have an impairment loss of 184. So I'm going to now record this impairment loss. So in total, I'm going to record an impairment loss of 184 plus 56, which becomes 240. I'm going to record a total impairment loss of 240. So what was my carrying amount? My carrying amount was 3800, right? And 3800 minus 240 is what I'm going to record the impairment loss, and in a way that gives me 3540, right? 3540 is what my 3560 is what my revised carrying amount after recording this impairment. I'm going to now compare this revised carrying amount. I'm going to add it the other corporate unit which is unallocated. I'm going to determine the total, and then I'm going to allocate it in terms of the overall corporate loss, if there is overall impairment loss also if I have. So I'm going to already record this impairment loss, right? 56 and 184. This is getting allocated to the corporate asset, and this is getting allocated to other assets. This 56 and 184. I'm going to allocate this in this proportion, right? And then I'm going to look at the impairment loss for the larger CGU. Impairment loss for the larger CGU is XYZ AUBU. So you have in total 4200 impairment loss, which I have already recorded, which is in total of 240 is the impairment loss which I have recorded. So I'm going to just quickly go back to see what was my total impairment loss, which is nothing but 184 plus 56, right, is the total impairment loss 184 plus 56, right? Total impairment loss of 240. So I'm going to come back here. So I'm going to record a total impairment loss of 240. So my revised carrying value is 3960, right? 3960, or what we were trying to do, is 3460, 3560 plus 400, right? 3560 plus 400. That gives my revised carrying value of 3960. My recoverable amount was 3900. Then this 3900 is again given information. This 60 is the additional impairment loss is what I need to record. That means the total impairment loss which I'm going to record is 240 plus 60 is 300, and then I need to allocate these 300 to each of these business units, the corporate units, as well as to cash generating unit in an appropriate way, right, on a pro rata manner. So I've already allocated 240, and now I'm going to allocate the balance 60 as well, right, which again will be allocated in the same proportion as these asset groups are forming part of the overall allocation. This 60 is going to get allocated on a pro rata basis, to and the principle which you need to remember, right, on a pro rata basis. What are the principle I need to remember for pro rata basis? That it should not, first you're going to allocate to goodwill. If you have a goodwill, then it goes to goodwill first. If you don't have goodwill, then you want to ensure that it is restricted to fair value less cost to sell. You don't go below that. If for that particular asset, if you know the fair value less cost to sell, you don't go below that, right? And you don't go below zero. Ordinarily you won't go below zero unless you need to record a liability. Then you follow another standard which requires you to record a liability in relation to that particular asset, right? Highly unlikely. These are how you do the principles of allocation, right? In this manner, follow a pro rata subject to these guidance. Pro rata subject to first allocate to goodwill, then ensure that the pro rata allocation does not result into carrying value of the revised carrying value of that particular asset to be below its fair value less cost to sell, or that revised carrying value should not become a negative carrying value, from that perspective. So we'll try and understand this again with the help of an example in terms of allocation of goodwill. So when you look at goodwill, allocate goodwill at the acquisition date to the cash generating unit that benefit from the synergy. So goodwill gets allocated to that cash generating unit to which it belongs, right? So let's say I've acquired a business XYZ Limited, and if that XYZ Limited is a cash generating unit and there was a goodwill which got acquired, then I'm going to allocate the goodwill to that cash generating unit. Now within that cash generating unit, there are multiple, within that business which I've acquired, if there are multiple cash generating unit within that business, I'm going to allocate it to the goodwill to each of the cash generating unit within the larger acquisition. Is what I have done. This should be done at the lowest level at which goodwill is monitored internally, which must not be larger than an operating segment before any aggregation for reporting purpose. And we will talk about segment and determination of segments and operating segments and reportable segment, so on and so forth. If the allocation is not completed in the period of acquisition, it must be done in the next reporting period. You may be required to do a reallocation of goodwill, right? If you were to do a reallocation of goodwill, what does it mean? That let's say in my example, I did XYZ Limited, right? And then XYZ Limited had three different business unit X, Y, and Z. I allocated it to this. I had another business division ABC Limited. What happens in future? I decided to merge both of them in a way, or decided to operate them together. Then the goodwill which gets allocated to XYZ may also require to get allocated to a larger in a way business unit. So you got to continuously monitor the fact pattern to determine. Now you just don't change the allocation of goodwill like that. If there is a change, then you got to test it for impairment before the change, and you test it for impairment after the change, just to make sure that people are not taking advantage of this rule, and hence they will continue to then to defer impairment of goodwill by keep on allocating the goodwill to a profitable business unit and so on and so forth. So before you change the allocation of goodwill to a cash generating unit, you got to test it for impairment before the change and after the change, in a way to determine is there any impairment which you need to record. Now once goodwill has been impaired, it is not allowed to be written back. Unlike other impairment losses, if you have recorded an impairment loss, a subsequent reversal of the impairment loss is allowed to the extent of the impairment loss. But goodwill, if you is already been impaired, you are not allowed to reverse the impairment loss in relation to any goodwill. An entity may reorganize its reporting structure in a way that changes the composition of one or more CGU, as I was trying to explain here, right? That we are trying to change the composition, which may then require the goodwill to be reallocated. Ind AS 36 requires goodwill to be reallocated on the basis of relative value to the units affected, that is to the revised carrying value of those CGU, or to the operations in a way disposed of. For a disposal, goodwill is allocated between the operations disposed of. For you to determine how much profits I have made from the disposal, the goodwill also gets loaded to the disposed unit if there is a goodwill, and then you determine the profit or loss in relation to that unit which has already been disposed, and then you deal with only the remaining goodwill, from that perspective. So all of this, the allocation process is important for you to be clear in your mind, that the goodwill, when it is acquired, gets allocated to the cash generating unit, and cash generating unit is the smallest identifiable group of assets which are capable of generating cash flows on an independent basis, where they are not dependent on other parts of the enterprise. You got to, this is a judgment, you got to evaluate this. If they are not independent, they're dependent, then you keep on allocating goodwill to a higher level from that perspective. Now, once you have done the allocation of goodwill to a cash generating unit, you got to test it for impairment, right? Goodwill, you have to mandatorily test it for impairment on an annual basis. The cash generating unit, otherwise you will only test it for impairment whenever there are triggers. Now, if the goodwill gets allocated, there is a possibility that you may need to reallocate the goodwill to a different a cash generating unit if there is a change in business, the way the business is being run and operated. However, for you to be able to do that, you need to test it for before reallocation and test it after reallocation to determine is there any impairment. If there is an impairment, you got to record that impairment immediately. If you've disposed a business unit to which the goodwill belonged, then the goodwill also gets de-recognized. That portion of goodwill also gets de-recognized, and then you got to determine the profit or loss for that disposed business appropriately. Ind AS 36 does not expand on what is meant by relative value. Ordinarily, you will do it again with reference to the carrying value, right, based on the way we saw in the previous example. It does not mandate fair value less cost to sell, but it might still mean that the entity has to carry out some sort of valuation process on that part retained. So all of that is what you need to be mindful of. As you look at the allocation and as you look at reallocation of goodwill. Let's try and do this with the help of an example. Goodwill had previously been allocated to the cash generating unit. The goodwill allocated to A cannot be identified or associated with an asset group at a level which is lower than A except arbitrarily, right? A is to be divided and integrated into three other cash generating unit B and C and D. Now A is getting divided and now getting merged into three different unit. How the goodwill should be allocated to B, C and D? Now the answer is that the goodwill needs to be allocated to B, C and D on an appropriate basis, and that can be done based on relative carrying value of B, C and D. Goodwill allocated A cannot be done arbitrarily identified or associated. It is reallocated to unit B, C and D on the basis of the relative value of the three portion of A before those portions are integrated with B, C and D. So you got to determine those relative value and then gets allocated to B, C, and D in an appropriate systematic manner. So depending upon the information which is available, you will have to exercise your judgment and appropriately do the accounting and reporting and disclosure, for such situation from that perspective. All right. So now we're going to look at this example. Okay. Sigma Limited operates several manufacturing units across the country. Several years ago, one of the plant was acquired by Sigma Limited as part of a business acquisition transaction. Okay. Goodwill of INR 20 crore was allocated to Plant 1 at the time of the transaction. Now, today, on 1st of January 2018, Plant 1 has a carrying value of INR 100 crore and an estimated remaining useful life of 10 years. All right. Estimated value, residual value is nil. Sigma Limited follows SLM method for depreciation for Plant 1. The recoverable amount for Plant 1 is INR 60 crore as at 31st of December 20. My carrying value is 100 crore and goodwill which was allocated was 20 crore and my recoverable amount is 60 crore. Okay. What is the amount of impairment loss to be recognized for Plant 1 and what should be the allocation under Ind AS 36? Okay, so I need to look at the Plant 1 and then I have to add the goodwill, then I have to determine the total carrying value, then I'm going to look at for recoverable amount and then I'm going to record the impairment loss, and then the impairment loss needs to be allocated first to goodwill and then to the remaining value of the asset in that order, right? So that shouldn't go below fair value less cost to sell for individual asset forming part of the CGU. Okay, so measurement principles as per Ind AS 36, the impairment loss should be first allocated to any goodwill, allocated to the cash generating unit, and then it should be allocated to other assets of the unit pro rata, okay, other assets pro rata on the base of carrying amount of each asset in the unit. However, an entity shall not reduce the carrying amount of an asset below the higher of. It is important, right, for you to fair value less cost to sell, its value in use, and zero. It can't go below zero. Okay. And the other thing, and why is this, right, is because let's say if there is a receivable, right, as part of that asset group, and you allocate the loss to the receivable, and next day you realize this receivable, then there will be suddenly a gain in the P&L. So idea is that the allocation shouldn't go below their fair value, right, as the highest of, okay, higher of. So carrying amount on 31st of December 2018, I have historical cost goodwill. My identifiable asset is 100. Total is 120. And then I'm going to record depreciation for that year. So it becomes 20, 90, 110, right? So this information, let me just go back to the question for a second. Yeah. The information here was 1st January, right? The dates are very important, okay? Dates are very important. All right. So let me come back. Yes. So first I need to determine the carrying value at the 31st December 2018, and that number comes to 110. I'm going to record the depreciation. Now 110 is my carrying value. I'm going to compare that with the recoverable amount. How much is recoverable amount? 60, right? So I'm going to carrying amount minus recoverable amount, 110 minus 60 is 50 is the impairment loss. Okay. Now this 50 of impairment loss, I am going to allocate first to goodwill of 20 crores and then balance is left is 30 crore will get allocated to remaining asset. Okay. So 20 is going to get allocated here and 30 here. So remaining is 60 crores. So goodwill goes away from that perspective. All right. Okay, so now I want to look at this example, all right? Now, Omega Limited is a large conglomerate with investments in multiple subsidiaries, okay? It follows 31st March as the year end. Now, on 1st of July 2017, Omega Limited acquired the controlling stake in Kappa Limited under the following terms. All right, 80,000 shares of Kappa Limited were acquired by exchanging 2 shares of Omega Limited for every 5 shares acquired. Okay, 80,000 shares of Kappa Limited were acquired by exchanging 2 shares of Omega Limited for every 5 shares acquired. Now, fair value of Omega Limited and Kappa Limited shares were INR 4 and INR 1.4 respectively on the date of acquisition. Okay. Now, cost incurred on issue of shares were equivalent to 5% per share. Okay. So 80,000 shares, there was the issuance cost, and other directly attributable cost was 10,000. So 80,000 shares for 2 shares Omega for every 5 shares acquired, 2:5 ratio. Okay. Okay. Fair value Omega and Kappa Limited were INR 4 and 140. Okay. So first we will determine the number of shares which are required to be issued. Okay. And then multiply with them the Omega Limited. Then we get the total consideration, contract consideration. Now, cost incurred, the stock issuance cost, right? That's not part of business combination. That is to be reduced from the uh, stock cost, right? Stock issuance cost is a capital cost. And then the directly attributable cost, that's also not allowed to be considered as part of the business combination. That's charged to the P&L as incurred under Ind AS 103. Now, fair value of identifiable net assets of Kappa Limited on the date of acquisition was INR 1,30,000. That's the fair value given. So we need to then determine the goodwill or other intangible. Now, Omega Limited opted to measure the non-controlling interest at fair value on initial recognition, for which the market value per share of Kappa Limited has been used. Okay, which is how much is 1.4, right? Okay. For the year ending 31st of March, 80,000 shares have been acquired. There have been 20,000 shares are there, right? Which minority. For the year ending 31st March 2018-19, no impairment is required for goodwill arising on acquisition of Kappa Limited. All right. Now, more information. Okay. It's a long question. Kappa Limited have identified 3 CGUs, 1, 2, and 3 for its operations. And Omega Limited determined that the goodwill on acquisition of Kappa Limited can be allocated on a reasonable basis to CGU 1, 2, and 3 in the ratio of 2:1 respectively. Okay. The recoverable amount and the carrying value asset which are forming part of this CGU as follows. For 3 CGUs, carrying value before goodwill allocation. So we got to first determine the goodwill also, right? Is 60, 55, 45, and recoverable amount is 74, 65, and 40,000. Now the question comes: required. What is the value at which goodwill is recognized on acquisition of Kappa Limited? Should be carried for the year ended 31st March 2020. Or is the amount of impairment loss to be recognized in consolidated financial statement, including the allocation of impairment loss to NCI in Kappa Limited? All right. Okay. So 2 questions. One is I need to determine the goodwill. The second is I need to determine the impairment loss, and also how much of impairment loss to be allocated to my consol as well as to minority or non-controlling interest holders. All right. So first I need to determine the goodwill. How do I do that? As I said, first let's assess how many stock I need to issue, and I know the fair value of the stock. Okay, stock issuance cost is debited, not capitalized. Similarly, the this direct attributable cost, that's expensed as incurred. Okay, so goodwill. So first consideration paid, 80,000 into 2/4 into 4 is the value per share. That gets to 1,28,000. Okay. Then I'm going to record the non-controlling interest. 20,000 into 1.4 is 28,000. Okay. Then fair value of the identifiable net assets acquired is 1,30,000. Okay. That means my goodwill on acquisition is 26,000. 26,000. Awesome. That's okay. Step 1 done. Step 1 done. But some more notes. An acquirer shall account for acquisition related cost as expense in the period in which the costs are incurred, and hence should be included as part of consideration. and should in which the cost incurred hence should not be included. Okay, hence should not be included as part of the consideration. Any cost of issue of shares, okay, are charged against the equity. Therefore, any directly attributable cost should not be considered for goodwill calculation. Okay, okay, awesome. All right. So that's step one done. That's the first question. Now I'm going to look at second, which is to determine the impairment loss. Okay. So I have the CGUs, the value, the recoverable amount, all of that. Let's look at step by step. Okay. Now I'm going to calculate the impairment loss. So I have the CGUs 1, 2, 3, 60,000, 55,000, and 40,000. Step 3, there is 40,000. Okay. Then I'm going to allocate goodwill in the ratio of 2:2:1. Okay. Which is the information given, right? I'm going to allocate in the ratio 2:2:1. That is 26,000. Okay, and that is 26,000. And after allocation, the this becomes 70,400, 65,400, and 45,000. So 1,81,000. Then I have this information of recoverable amount as well. Okay. So my total impairment comes to 5,600. So here there is an impairment and here there is an impairment, which I need to record. Okay, awesome. So then let's just look at calculation of goodwill, right? So the impairment loss first gets allocated to the goodwill. Okay. So my original goodwill was 26,000. The impairment loss, which is 5,600. My goodwill after impairment loss is left is 20,400. Total impairment which I'm going to record is 5,000, which I recorded at the individual CGU level, which is in asset C, and as well as 5,600 of goodwill loss. The total impairment loss is 10,600. Now, of the above impairment loss, I got to allocate to the minority, which is 20%, right? And the balance 8,480 is allocated to the shareholders of Omega Limited. This is what goes to the shareholders of Omega. So that's how, in a way, we've kind of done the overall impairment understanding, assessment. Now, I also talked to you about the impairment of asset, which are to be tested at least annually. The following assets and need impairment testing on an annual basis. For others, you're going to do it as and when there are triggers, which are external and internal. So goodwill, which is acquired in a business combination, needs to be tested. Intangible asset with an indefinite useful life, or intangible asset which is not yet available for use, that means which is under construction or under development. The most recent detailed calculation of recoverable amount made in an earlier period can continue to be used provided all of the following conditions are met. What does this mean? That you don't need to do this again and again. If the intangible asset is part of a cash generating unit, the cash generating unit assets and liabilities have not changed significantly since the previous calculation. So again, it is a simple thing to say that I made some assessment at a previous measurement date, right? Now, whatever assessment, assumptions, estimates I have done, are they continuously valid in a subsequent period measurement date? Now, that is only valid if there is no significant change in circumstances, which makes you believe that there is going to be a change in estimate of future cash flow. There is going to be a change in discounting rate, etc., etc. Similarly, that goes for the assessment of fair value less cost to sell. You keep on assessing this, that what are the factors which resulted into determination of these values. Have these factors changed? If those factors have changed, then you got to redo that same thing. Otherwise, you can leverage what you have done recently for you to continuously assess, is there an impairment, is there a trigger for impairment, from that perspective. So we got to continuously analyze the intervening events, from that perspective. The impairment test may be performed at any time during an annual period, provided the test is performed at the same time every year. So once you decide to perform, it's not necessary that you need to do it at the year end. If you want to do it in March, you want to do it in December, you want to do it in January, whichever thing you decide to do, you got to then do it consistently or more frequently if there are triggers. So if there are no triggers, then you don't need to do it. But wherever you are doing it on annual impairment, like for goodwill, like for indefinite life intangible, or for intangible which are yet to be available, you got to do it on a definitive date. Or if there are impairment triggers, you got to do it on that date. If there is a reversal, we talked about, you are not allowed to reverse the goodwill impairment loss, but for other impairment losses, the reversal is allowed to the extent of the impairment loss is what you have recorded. So impairment loss, if no longer exists on an individual asset, reversal is limited to the amount that brings the asset back to the carrying amount at which it would now be stated if no impairment. So for example, if this is a depreciable asset, right, and you got to keep on depreciating it, right, so you got to then compare that if I would not have impaired this was my carrying value, this much I would have anyway depreciated, and hence it should not be then higher than that, from that perspective, right, because you are following end of the day historical cost basis, charge to P&L or revaluation reserve as applicable, and adjust the future depreciation. If they are cash generating unit without goodwill or with goodwill, right, from a without goodwill perspective, allocate the pro rata to asset with an upper limit of the lower of their recoverable amount, the carrying amount, if impairment had not been reduced. With goodwill, again, no reversal on goodwill. Others, you are, as I just said, you are allowed to in a way reverse this. From a disclosure point of view, you got to disclose, and disclose. For impairment for each class of asset, amount of impairment loss which is recognized or reversed during the period, you got to disclose. Amount of impairment loss or reversal on revalued asset in other comprehensive, you got to disclose. If recognized in profit or loss, disclosure where it is included, segment reporting, events or circumstances leading to impairment, disclosures when impairment losses are material for an individual asset. So you got to disclose, discount rate which is used, estimate used to measure the recoverable amount. So if there is unallocated goodwill, number of disclosures is what you need to make. So for us to summarize in a way what we've talked about, you have understood the concept of the CGU. CGU is nothing but an individual asset or a group of asset, which are the smallest identifiable group of assets where you can generate cash flows on an independent basis, and then at which the discrete cash flows are available or the financial information is also available. And when we think about cash flows, it includes both cash inflows and cash outflows. We talked about the impairment of goodwill. Goodwill impairment is to be done on a mandatory basis, on an annual basis. Now, the reversal of impairment loss on goodwill is not allowed. If you have goodwill which is forming part of that cash generating unit, if there is an impairment loss, that loss is first allocated to the goodwill before it gets allocated to the other assets or forming part of that cash generating unit. We talked about the reversal of the impairment loss. Impairment loss is allowed to be reversed to the extent of the law. If there is a subsequent reversal of the impairment, a subsequent improvement in the situation, then the impairment loss is allowed to be reversed to the extent as if the original carrying value depreciated to the current value. To that extent, you are allowed to reverse. Goodwill reversal, goodwill impairment is not allowed to be reversed. And then you've got to, of course, disclose, and disclose. So when we look at some of the quick comparison between Indian Gaap AS28 and Ind AS 36, now AS28 does not require the annual impairment testing of the goodwill. I mean, the Indian Gaap is all over the place when it talks about the impairment of goodwill, because AS14 wants you to amortize, AS10 is in a way silent, so and AS26 also doesn't talk about it. So goodwill, we see a diversity in accounting practice under Indian Gaap. Under Ind AS, you are not allowed to amortize it, but you are supposed to test it for impairment, and that's where required to be done on an annual basis. Now, reversal of impairment loss for goodwill is not permitted under Ind AS. Ind AS 28 required that the impairment loss recognized for goodwill should be reversed in a subsequent period when it was caused by a specific external event of an exceptional nature that is not expected to recur, and subsequent external event that have occurred that we have, in practice, it's extremely unlikely to see any reversal of impairment loss on goodwill even under Indian GAAP. So goodwill once impaired is not allowed to be reversed, period. That's how we see that in practice, from that perspective. Looking at some of the other differences, bottom up and top down. So Ind AS 36 goodwill is allocated to the cash generating unit, a group of cash generating unit that are expected to benefit from the synergies of the business combination from which it arose. There is no bottom up or top down approach for allocation of goodwill. AS 28 in a way prescribes a bottom up or a top down approach in a way. So this may result in some different accounting outcome. So and you've got to look at that carefully, but not relevant, from our perspective when you look at the principles of Ind AS 36 and how goodwill needs to be allocated. So we saw an example that you got to again determine an appropriate basis which you need to then apply for the purpose of allocation, and normally that is based on the fair value of the cash generating unit immediately before the allocation of the goodwill. That is how you allocate the goodwill to different cash generating unit from that perspective. So with this, we've come to an end of this session on impairment Ind AS 36. I hope you are now clear in terms of some of the nuances on impairment and Ind AS 36. What we are simply trying to suggest here is that you've got to test your assets for impairment and you've got to look at the scoping. If there are other accounting standard in which the particular item of asset is covered, like inventory, like financial assets, you've got to the respective like contract assets under Ind AS 115, you go to the respective standard. Otherwise, you come to a standard Ind AS 36, and if the carrying value exceeds the recoverable amount, that means there is an impairment. Recoverable amount is the higher of your fair value less cost to sell and value in use. Now, fair value less cost to sell is something which is determined with reference to an exit price and also consider the cost to sell, which are like legal cost, stamp duty, etc., etc. Then you look at your value in use. For you to determine your value in use, you got to estimate your future cash flows, and then you got to also apply an appropriate discount rate. You compare both the amount, compare with the carrying value to determine if there is an impairment. Now, this impairment, you don't need to do this on an ongoing basis. You have to actually assess impairment for impairment triggers, and impairment triggers could be external factors or internal factors. You evaluate this on an ongoing basis. If there are triggers, then you do this exercise, and then you assess that if the carrying value exceeds the recoverable amount. If the answer to that is yes, you record the impairment loss. You also look at if there are unallocated assets. You assess your cash generating unit. Cash generating unit is assessed at the smallest identifiable group of assets which can generate independent cash flows. And that is the level at which you do your impairment testing, and once you have tested it for impairment, you allocate the impairment loss to each of the assets which are forming part of this cash generating unit, and you once you do the allocation, if there's a goodwill, you first allocate to goodwill. If there is no goodwill, then you allocate it, but you don't go below the fair value less cost to sell, or you don't go below zero. You allocate it on a pro rata basis. So all in all, then we talked about how do you look at the goodwill impairment. We talked about the reversals of impairment. Reversal of impairment is not permitted, for goodwill. Otherwise, you can do reversals to the extent of the assumption that how much would have been the revised carrying value if there was no impairment. From that perspective, if you're doing revaluation of your asset, of course, then if there is an impairment loss, the impairment loss gets allocated to the revaluation surplus, if any. Otherwise, the balance thing gets allocated to the profit and loss account, and then and also gets impacted in the pro rata carrying value of your assets which are forming part of the cash generating unit. You've got to disclose, and we also try to understand and discuss some of the differences between Ind AS 36 and AS 28. With this, we've come to an end on this session. Thank you very much, and my colleague is going to take you through with some more practice question. We're going to also cover some of the questions which were there in the examination. All of that is what we will aim to cover as part of our practice question session as well. Please enjoy and do provide your feedback. Thank you very much.